Jeff is the chief economist of Absa based in Johannesburg. So, Jeff, I think we've already started to eat into our time, so I'm going to hand straight over to you. Thank you.
Well, Dennis, thank you. And for everyone who's remained on the call, thank you for your patience. As introduced by Dennis, my name is Jeff Gable, and I'm lucky enough to be the chief economist for Absa. I work with a research team of about a dozen people on the economics and politics and foreign exchange and fixed income side of things. I was asked to spend some time today with you to talk through a little bit about where South Africa finds itself currently. And it won't surprise you to know that when Juliet and Dennis and others in the chamber and myself and my colleagues at Absa sat down to frame out the talk today, the environment was a little bit different than the environment we find ourselves delivering in. But nevertheless, I think there's quite a number of really important points to make around how South Africa faces off against its domestic challenges currently and also kind of the new global challenges, and then where sort of the path forward is. Let me just pop up some slides for you, and that will help guide the talk today. I think of all the titles I've had for South Africa, this one might have the longest shelf life. It's never easy. And within that, to talk around the detail, I suppose, really from the beginning of last year, or perhaps even late 2023, from the research side, from the macro side, one of the messages that we were delivering on South Africa was that, in fact, things were starting to look a little bit better. And we saw that, first of all, maybe in some of the progress in reforms or sort of the change in emphasis before it started to show up in the data. And then, of course, we went through the end of load shedding from sort of late March of last year, which frankly caught everyone by surprise. And it's apparent at the time resilience. Then we went into the election process in South Africa. And though we were disappointed with turnout at the election, a lot of excitement in terms of the signaling that it gave and the ability for parties from very disparate parts of South Africa to come to work together in the government of national unity. And so our expectations were that, in fact, things were looking a fair bit up. And so we as Absa Research put out forecasts for this year that suggested the economy could grow even 2.1 or 2.2%. That, if you cover up the COVID period, that would be the strongest economic growth the country had seen in quite some time. And then just in recent month or two, things have started to look a little bit more nuanced. And so the first graphic of the pack today that I hope you can see is taking a look at business confidence. I don't need to speak to at great length the people of this call to say that confidence is absolutely critical and business is absolutely critical. Without business, there's very little economic growth. Without a confident business, there's very little investment. And so the two big takeaways from this graphic, part of it you have seen many times before, is that for the better part of 15 years, South African businesses were to varying degrees not very confident about their economic future. There were two tiny quarters, either of those more than a decade ago, where business confidence had gone slightly positive. But for a very long period of time, to varying degrees, business was more worried about tomorrow than they were about today. And then we'd seen sort of for 3 or 4 quarters, from early last year, we'd started to see the balance of business confidence start to improve, moving towards a neutral territory. And in the most recent quarter, the data for Q1 of this year, you've seen that flat line, no further improvement. We wanted to interrogate a little bit more about what's behind that because it helps us understand the way forward. One of the best data sets I think we have is just from the manufacturing sector. So it doesn't speak to services, it doesn't speak to mining, it doesn't speak to government, but just from manufacturing, it asks manufacturers, what are the things that are holding you back? And that's really critical, right? Because manufacturing might be small or big business, it might be import competing, it might be export oriented, but around that, what did we see? So this graphic on the right goes back better part of 20 years. In the orange line at the bottom, you read this as saying that as of the first quarter of this year, about 4 in every 10 manufacturers, as part of this quarterly survey, said that short-term interest rates were still a challenge for them, but that was down by about a third off its peak about a year and a half ago, before the interest rate cycle had started turning in a more favorable way. Lack of demand, some ways the most obvious. We have about 2/3 of manufacturers in South Africa saying critical thing holding us back is just we're not sure there's enough appetite for our product. But the black line on the graph on the right was the one that I thought was most interesting. For almost, for a little bit more than a decade, single most cited thing almost each and every quarter, it was policy uncertainty. It was the politics of the country being cited by more than anything else by manufacturers in South Africa, saying this is what's really holding us back. And that got to the point in the run-up to the ANC's elective conference a little while ago. It got to the point where 9 out of every 10 manufacturers were saying, gosh, this is really what keeps us up at night. And what we'd seen in the aftermath of the formation of the Government of National Unity was a very sharp fall in that. And in the most recent quarter in Q run, another rise. So that gives us one of the hints as to one of the things that's maybe causing us a challenge, and we need to think about that in terms of the way forward. But there are other aspects here as well. So I touched briefly in those opening comments around load shedding. You will know, if you have exposure to South Africa, that really since early 2008, the country had been electricity constrained. In March of last year, we went from a period where load shedding was amongst its most intense that we'd seen in 15 years to an almost sudden stop of load shedding in almost a year. We got to put 10 and a half months before there were any real challenges. Unfortunately, we're back in that period where question marks are being raised about just how resilient some of the improvements in electricity supply have been. The way that we do 2 graphs here, the graphic on the left is measuring energy availability in sort of a theoretical construct. If all of Eskom's plant and machinery were up and running, energy availability would be 100%. Now, of course, no global utility looks to achieve that. You always have to have some stuff offline for preventative maintenance. Sometimes things go wrong. But what we're seeing right here in 2025 is, after a start of the year much stronger than the last few years, energy availability of 56, 57% in the early parts of the year. In fact, we've gone sideways to slightly down at a time when the country transitions from summer into autumn and then critically into winter, where there's much more demand for electricity than there would otherwise. Another way to think about why people are more worried about electricity today than they may have been a quarter or two ago, the graphic on the right is looking at the energy that we're generating per month from open cycle gas turbines. So these are meant to be peaking plants, very expensive to run. But what we're seeing is that, unlike 2024, when the electricity environment got much better from late March and sustained itself throughout the rest of the year, in fact, we're tracking at multi-year highs for how much diesel we're burning in these turbines. And that's sort of a strong indication that something somewhere in the system isn't working very well at all. Again, these are meant to be peaking plants, not meant to be base load. Diesel's an enormously expensive way to generate electricity when you are a grid operator. So part of what's denting confidence right now must be question marks over electricity provision. The second one, of course, and we're not alone in this in South Africa, though we did, in terms of the picture in front of you, we are just below, we're 2 lines below Malaysia. So we just about made the front page of the newspapers as being the first poster board that the White House and Donald Trump unveiled, President Trump unveiled on the 3rd of March. But we're kind of all learning globally what all this means. And I know that this is just as true for the UK as it is for us in South Africa. In some sense, in the UK, it may even feel a little less fair, given that the US runs a small trade surplus with the United Kingdom rather than the opposite way around. But if we think about it in this broadest way, the problem statement from the White House wasn't a very complicated one. The problem statement was, well, if somebody's exporting more goods to the US than they're importing from the US, then there must be a problem. There must be some element of unfairness. The way we're going to measure this is very straightforward. A reciprocal tariff just looks at the trade gap with the country divided by how much that country sends to the US. which feels a little bit arbitrary if you spend much time around economists, but then in an even more arbitrary fashion, you divide it by 2 and you get the number. So for South Africa, if measured from the US side, in 2024, South Africa exported almost $15 billion worth of goods to the US. The South Africa imported, according to the US, just less than $6 billion from the US. And so you do the simple calculation, and apologies that 14.7 should be 0.9. You get 60%, you divide that by 2, you get 30%, and that's meant to be the tariff on South Africa. There's some nuance here, right? Energy and critical minerals are initially excluded. So about half of South Africa's exports fall under those categories. That's precious metals in particular. The second nuance here, and you will have been impacted by this in the UK, there's a lower bound on this stuff of 10%. Even if you aren't seen as unfair to the US with this very basic calculation, you still take it on the chin a little bit. It's only for 1 year of data. It's for goods and not services. But the other critical bit of this for South Africa, for our neighboring countries, for everywhere in the world, is there's no direct mention of just what a remedy should look like. And so you'll see various responses already, right? The Chinese one has not been terribly helpful to China. I think we would all kind of agree. Vietnam moved very quickly to slash tariffs against the US, given the Vietnamese economy's dependence on exports to the United States. We saw similar moves here in Southern Africa. Zimbabwe moved very quickly to slash tariffs on US imports. Democratic Republic of Congo has looked to placate the US by announcing closer alignment on critical minerals and investments in the mining sector. But really, to date, no one has any strong signal from the White House as to just what the way forward is. All of us are watching with extreme interest. And of course, the planes to Washington are full, with delegations going to try to use this 90-day window in order to secure somewhat better deals. For South Africa, and thinking about where the rubber hits the road in a more concrete way, first of all, South Africa's trade with the US, and this is kind of true for all countries, it's complicated. So I mentioned before, South Africa is measured from the US side. What the US says it imports from South Africa versus what it exports. It reports that we run, as South Africa, a $9 billion surplus with the United States. And on that measure, South Africa is the 15th largest trade surplus with the US. If you ask South Africans, we think the trade surplus is closer to $2 billion. And there's a couple reasons for this, but largely on the commodity side, who we export a commodity to might not be the end user of that. And the US looks to fashion a system whereby it understands where the raw materials are coming from and measure it that way. But in any event, you get a big gap, a really big gap between the two of them. Second part of the complication here for South Africa is that our exports in many ways are really diverse. So there's 7 product lines. So things like gold and platinum, things like automobiles. There's 7 product lines with exports in 2024 where the individual product line was worth more than $500 million. Then there are 7 product lines that were just slightly smaller than that. But then as you move down the export chain, you end up with this incredibly long tail. There's more than 2,000 product lines that South Africa exports to the United States where trade is less than $10 million. Now, those are product lines that are likely not to be well represented in terms of negotiations or discussions. It's just not possible in that space. But what it highlights is that the potential impact here can be very large for a country like South Africa. Third part of this, I suppose, exports are focused. And what do I mean by that? It's a little bit of play on words, trying to be different from saying they're diverse. But focused means that 41%, if you measure it from the US perspective, 41% of South Africa's precious metals and stones are US bound. 16%, about 1 in every 6 bits of our automotive exports, whether they be final vehicles from companies like Mercedes or BMW, or whether it be components like catalytic converters. About 1/6 of South Africa's global exports in the automotive sector go to the US. Almost 40% of our exports in ships and boats. And so those are the areas where the impact of this is likely to be most complex and particularly most disappointing. Now, the US problem statement, remember, was that, well, gosh, if a country is running a trade surplus with the US, then to a greater or lesser degree, they must be treating the US unfairly, and then we're going to measure it in this reciprocal tariff format. I don't think it is disputed that South Africa on the AGOA side historically has had very little friction for South African exports going into the United States. Average tariff level going into the US was a number that was just less than 1%, for example. At the same time, South Africa, and lots of countries are similar to this, have active tariffs on a number of US import products. And it's much, much longer than this list of 5 or 6 things that I've given. But for that same tariff-free access that the South African automotive sector had been enjoying in the US, a US manufacturer looking to import a vehicle from the US into South Africa faced almost a 1/4 tariff. Rubber articles that include tires in there, 27% tariff, alcohol drinks. So certainly there's something to this, the idea that the US is being treated very differently than the US has been treating South Africa. But what are the next steps, and what does Liberation Day mean? Well, Liberation Day for South Africa was originally 30%. Now, when there were this 90-day period of 10%, there's 25% on auto exports. It's a little bit complicated, a little bit unclear. The real damaging aspect here is twofold, right? One is just the uncertainty that exists, and not the broader uncertainty. Where as a company do I make my next investment decision to put production? The uncertainty of just what do I put in a container today and put on a ship, and under what circumstances is that going to land in the US? It's enormously complicated right now. And as I'd mentioned, it's also very unclear as to just what's being asked of countries for them to do. What can South Africa do in terms of mitigation? Well, like many countries, we're thinking about rejigging some supply chains. So it could be that some of the vehicles that we were producing for consumption in the US, we now redirect those into markets into Europe, perhaps, and then Europe will look at some of the American production that was going to Europe. It's not at all clear what's going to take place here over the next little while. We also know that weaker global demand. IMF released new updated global economic forecast last week, ripped more than 0.5% off global GDP growth for this year, ripped almost 1% out of the US economic growth, some out of Europe as well. And then maybe this is going to give a greater impetus for faster progress on the implementation of things like the African Continental Free Trade area. But that is something that will take years to generate, as again, as the UK witnessed in terms of trade ties with Europe, both in the deepening of those trade ties originally and then the challenges of those trade ties since Brexit. Next broad point that we've had in South Africa that took place in the first quarter and may certainly be impacting confidence is just the discussion around the budget, right? So previously, South Africa's budget process, certainly in the democratic period, was pretty straightforward, right? Third week, sometimes the fourth week of February, finance minister stands up in front of our parliament, delivers the budget speech. Behind that is a whole bunch of enabling legislation. That enabling legislation gets passed slowly through the process over the coming sort of 3 or 4 months. No one pays a second thought to it. Once the speech is done, we all think that we know the answer and away we go. Of course, 20 minutes before the speech was to be delivered in February, the speech got pulled. And so we had sort of chaotic scenes for 3 or 4 weeks. A new budget was delivered, and now it looks a little bit chaotic since then. At the forefront of those disagreements was this discussion around VAT. In the initial budget proposal, it was to be 2%. That budget got a 2% increase from 15% to 17%. After several weeks, a revised proposal was put forward, which was giving us just 0.5 percentage point increase this year and an expectation of a 0.5 percentage point next year. And on this, not only has business and consumer confidence sort of fallen, but there were real concerns we might lose the government as well. I wanted to spend a moment just to put this into context. The shading on your screen here is done proportionately for a reason. Personal income taxes are expected to generate just over 800 billion rands in the current fiscal year. Corporate income tax at the bottom is about 1/3 of a trillion rand. Other includes things like the fuel levy. It includes excise and duties. It includes a whole bunch of other things, about 580 billion rand. And then you see this segment for VAT. The expectation in the revised budget was that VAT would generate just shy of 500 billion rands in revenues for government. And what was being debated and fought over, with the risk of the government falling, was that much. So this is to scale of the total revenues of government being the size of the entire page. This is what we managed to trip over in South Africa over the last number of weeks. So there's a context here to highlight that there's the kind of not a disagreement on everything, there's disagreement on fairly small bits. What are the ways forward here? Well, on the politics side, I suppose over the last few weeks, it's depended very much upon who your favorite political commentators were, or maybe revealing some of our own biases. Certainly, there were periods where it looked like the continuation of the government of national unity, at least with the two main parties in it, the ANC and the Democratic Alliance, was very much at risk. That now seems much less the case. And within that, there was all this discussion about bringing in outside support for government orders. The politics of this thing in terms of the government of national unity looks clearer cut now. It looks like the 10 or so parties that are in it, but critically the ANC and the DA are in it for a longer haul. So that's very critical. The politics of the tax discussion got a little bit ridiculous at times, with every party fighting to get further ahead in the queue to describe themselves as the only people protecting the poor in South Africa. But I think we can kind of excuse that. That's just sort of a normal politics, I suppose. But then we're getting into the nitty-gritty. So on the weekend, I guess Friday going into Saturday, we received news that the court has made a ruling saying that the fiscal framework, that's the broadest bit of the budget environment, that the fiscal framework actually must now be withdrawn and rebuilt. And so you'll see headlines saying that the whole budget needs to be redone from scratch. I think that's probably an overexcitement. The budget process takes National Treasury nearly 10 months. The disagreements that sits in here are fairly small, but it does mean that the entire parliamentary process needs to go forward. Does this mean that we're likely to go nowhere for a period of time, that the uncertainty around the budget is likely to damage the economic outlook even more? I would be cautious about that negative approach or negative view on this. I think what's being missed throughout the last 2 months is that, in fact, there's very broad agreement on the vast majority of things in the budget. There's very broad agreement on the vast majority of things that represent South Africa's challenges. So even as politicians were tripping over themselves to highlight how focused they were on protecting the poor from a small increase in VAT, there was no serious discussion from any party, left, right, far, near the center, that the answer to this should just be to take on more public debt. There was absolute agreement across opposition GNU parties that a critical way forward here is about taking the expenditure reviews that in many cases have been done already, deep dives into understanding what government is spending its money on, what programs look like, and what the outcomes are, and sort of taking those things much more seriously than before. And interestingly, there were also no serious voices suggesting that a further push on economic reforms, a further push on private sector participation in projects, a further easing of the environment so that the private sector can help lead to the more economic growth that's so critical, that also wasn't a contested bit of terrain. And I think that's really important, because on the politics side, we try to make everyone, the parties try to differentiate themselves. But if you look at the actual actions and policy proposals they're not that far apart. And critically, in the coming weeks and months, there is no default on government debt. This isn't a debt ceiling standoff like we get in the US regularly. There is no government shutdown. This is not the sort of environment where you get a period where the NHS doesn't have appropriate money and certain programs need to shut down. The budget process here in South Africa is done in a way that has a huge amount of resilience in it. So we can continue to roll forward here using modified versions of last year's budget right through to September, October, potentially even November. So there's nothing big or sharp that needs to happen. I mentioned that was broad sort of support for reforms, because here's where I want to start building. We've gone from the challenges, right? So the challenges in the environment was that we worried a little bit about electricity. We're quite worried about relations with the US, and that now we've had this excitement around the budget and the government of national unity. But I want to build the case that there's a lot more resilience here than we might be fearful of, that there's a lot more steps going in the right direction than the wrong. And the critical start of that is just on the reform progress. So on the electricity side, I may have highlighted that Eskom looks to be running harder right now just to stay in place. But there's been huge change over the last number of years around private sector participation, either on the IPP side, particularly in renewables, but also in carbon-based energy. We've made big progress in terms of de-verticalizing Eskom and getting us closer to the point where there'll be genuine competition in transmission and production. We've seen on the transport side of things, we know that the rail network and the port networks have really let South Africa down. We know that the busiest container port in South Africa, Durban Pier 2, we chose a preferred bidder as a country for private sector participation there. We chose a big global player, preferred bidder, back in the tail end of 2023. It's held up in the courts. The courts have had their hearings in March. We hope to get some outcome of the next little bit. But already critical new infrastructure has been delivered even into that port. We have requests for information, requests for proposals having gone out in terms of getting private sector involvement in different parts of the rail corridors, in the rolling stock. Really critical things have happened. And that should deliver us South Africa in the periods ahead. And this is not a half decade or a decade ahead. It's not next Wednesday. But in periods ahead, South Africa that's better able to provide the infrastructure necessary to compete on a global stage. And that's really critical. Now, there's a lot left to be done here around mining charter and mining rights, real question marks over sort of the right direction to take economic empowerment in South Africa, land reform and others. But really critical changes have been made already, and they will start to see positive fruit in the periods ahead. Second bit that helps us, and it's a little bit nearer term, but it's important, is just that we come into this without an inflation problem. So the table in front of you, the rightmost column is the most recent print on inflation, and everything that's green there is either lower than a year ago or comfortably below the Reserve Bank's, even the center point of their target. In most cases, it's below the lower part of their target as compared to a year earlier. And so into this environment, we have space, right? Global tariffs aren't going to generate a bunch of inflation in South Africa. It's a bunch of uncertainty. The Reserve Bank has approached this in the most recent MPC meeting, but 5 weeks ago, with a decision, a 4-2 decision to keep interest rates on hold. But as that uncertainty dissipates somewhat, the expectation is the inflation outlook itself should provide some important space to provide support for the economy. And that's what we're seeing financial markets pricing in. So the black line here, it's listed as today, but in fact, it was close of business on Friday. My apologies for that. We had a holiday here yesterday. But what this is showing is that financial markets are now pricing in two and a bit small rate cuts between today and the end of this year. And that pricing has varied wildly. Just barely a month ago, interest rate cuts had all but been priced in the immediate aftermath of the election. It wasn't just more interest rate cuts now had been priced out, but in fact, financial markets didn't believe any cuts were coming at all, certainly not the 75 basis points we had already. So there's some support here that's going to come into the economy. It will help business, of course, but also critically help consumers. What's often underappreciated in South Africa is just that virtually all borrowing in South Africa is twofold, right? One, it's all in rands rather than hard currency. So as the rand moves up and down, it doesn't place the same pressure in South Africa than perhaps is seen in other emerging markets. But on the consumer side, twofold. One, there's an awful lot of debt, right? Debt to disposable income for households is currently about 2/3. So it's not insignificant, but that debt is fully floating. In a rising interest rate cycle, this is a critical weakness, right? The house you bought 10 years ago suddenly becomes more expensive. The car you bought 3 years ago suddenly becomes more expensive the day after the Reserve Bank announces an interest rate change. But in this easing cycle, it'd be very helpful. The table on the left, the right-hand column is taking a look just in rand terms. If a person's income had held up with inflation rises over the time, how much larger their income would be today than it was in the past. So for somebody comparing them today to very early of January 2016, incomes in rand terms would be up about 2/3, 68%. For the house that you bought, if you bought your house in January 2016, your interest payments are about 9% higher today than they were then. Just means the policy rate, the prime rate, slightly higher today than it was before. But that 9% higher compared to an income that's up almost 70%, there's not a challenge for this consumer. And if interest rate markets are correct, you get this little shadow 5 in that same row in the table. If interest rate markets are correct, another 4 percentage points of household spending is going to come out. Be delivered back to households at the end of every month because they won't be spending it on their bond payments, for example. Now you can see it's green in this table for if someone bought a house in 2016, 17, 18, 19, 20. Somebody bought a house in 23, 24, early 25. In all of these cases, income has risen by much more than interest payments. If you timed your purchase about right, in fact, your interest payments are lower today than when you bought your home. But there is this narrow cohort. People who bought homes when interest rates at their absolute lowest after COVID, of course, interest rates are a chunk higher than that. And that gap is closing, right? When we first started doing this table, their interest payments had risen by more than 40% in the first year after they took out that loan. I can't imagine that being a very comfortable discussion at any dinner table. But the interest payments are coming in a little bit lower, income's having a time to catch up. So consumers in general should start to look more confident. We see that broadly in the credit quality data that the National Credit Regulator produces, where new late payments from households in vehicle finance and mortgages and others have started to turn down. The other support that we get for households over the last while and over the next while, it's just some changes that were made here in South Africa to the pension system. So the changes that were made, it's now a two-part pension system. One part of your pension you cannot, the lion's share, you cannot access until you are of retirement age. The other part of your pension you can access in a much more transparent way than you did before. Previously, we had the curious circumstance in South Africa where some people would resign their jobs just in order to access parts of their pension. And so the new system provides more security for long-term savings by not allowing anybody to access a chunk of their pension. But curious enough, the near-term impact of this is that more people have more access. They just don't have to drop their jobs today. So what we've seen is from the 1st of September, when the policy, 1st of September last year, when the policy was implemented, to the end of February, which is the most recent data we had, 45 billion rands was taken out of South Africa's pensions. That makes an average withdrawal of just shy of £1,000, right? Might not feel like a whole lot if you're sat in London and you're reflecting on a dinner bill from your favorite restaurant. But here in South Africa, that's not insignificant amount. 40% of withdrawals were coming from people in their 30s, where much smaller amounts were coming from people in their 50s. Very small amounts, only 3% of individuals earning more than 600,000 Rand a year are accessing their pensions. So it's coming from those lower down on the chain. We will see another bout of these withdrawals from 1st of March, because the way the system works, it's per tax year. So I would expect some boost to consumer spending in the March in April data, notwithstanding all this uncertainty that sits out there. And then kind of your guess is as good as ours as to just what the money is being spent on. Though I think that the self-reporting from individuals, when asked what you're going to spend that pension withdrawal on, and they say, well, we're going to help pay down debt, I think there's anecdotal evidence to suggest that a fair bit of that money is being used in that manner. And of course, that feels kind of probably personal finance sustainable. If it were all going to buy new cars, maybe those maths would be a little bit different. The last of the supporting factors for South Africa, and then I'm going to sum up here. The last of the supporting factors from South Africa, oddly enough, is a direct outcome from sort of the global uncertainty generated by a very active, let's use this language, by a very active first 100 days from this White House and this US administration. So if we think about the three largest items that South Africa exports, platinum, first largest, followed by gold, followed by coal. In this environment, you've seen price of gold skyrocket, price of platinum rise in an impressive fashion, given that it's more of an end-use metal and the economic outlook is deteriorating. But even in the case of coal, coal is lower today than it was at the beginning of the year. But our single biggest import as South Africa is oil, and oil's fallen by even more. So I don't think as a country we would have preferred the global environment that we're in right now to a more benign one. But it's important to highlight that some sectors in South Africa, the extractive sector, should be very much taking advantage of the space. And just as a reminder, gold, platinum, in particular, are things that we do export to the US and are not covered under any tariffs, still duty-free access. Coal is not something we export in a meaningful way to the US. And that's sort of where I want to leave my thoughts. And I know we have a little bit of opportunity for Q&A as well. It's for sure a challenging environment, largely from the global side, but also we've had some own goals here in South Africa. But we are continuing to make more forward steps in economic and structural reforms than we're being sent backwards. There are sources here of near-term support for the economy, whether that be interest rates or commodity prices, two-pot pensions, others. It's also a little bit of a weird thing. For those of you who are South African, I apologize because I'm going to butcher an accent here in a moment. For those who are not, one of my favorite phrases in the 18 years I've been living here in South Africa, one of the most representative phrases I think of South Africa is an Afrikaans one, and it's "boer maak 'n plan," and it's a farmer makes a plan. And the idea behind there is that you get handed an environment, and then you don't sit and worry too much about it. You understand that environment, you decide what the best way forward is, and away you go. And South Africa, in my experience, is remarkably, it's not a great turn of phrase, but resilient at being resilient. So if we think about the country's economic performance over the last 10 or 15 years, it's been very poor. Per person, GDP, size of the economy is significantly smaller today than it was 15 years ago. That's not true for very many countries in the world. We haven't had big ups. We haven't had big downs. And as a consequence of that, and we're in an environment right now where everyone's writing down their economic forecasts for any country you can think of. Certainly that's true here in South Africa. But if we face in South Africa another year of economic growth of kind of plus minus 1%, which are where a number of the forecasts seem to be landing right now, that won't feel like a bust to us. Frankly, that would still be slightly stronger than we've managed to do ex the COVID years over the last decade. And so we see in that very restrained space, you see corporate South Africa going about sort of business plans that leave it resilient and profitable in that space. You see it in banks. You see from National Treasury in the budgeting process isn't expecting an economy to grow gangbusters in order to bring about a fiscal consolidation on what up till recently were very realistic economic assumptions, recognizing a very difficult environment, recognizing the need to make very difficult decisions. And then the last point I wanted to just make here, and I hope it brings the discussion a little bit full circle, is just if we think about that very first information page, we thought about business confidence and we thought about sort of the signals from the manufacturing sector. As South Africa, we have struggled to grow over the last 10 or 15 years. We can point to all sorts of micro challenges here, but the critical one is we just haven't had enough investment. And so confidence is critical for investment. Putting the reforms in place that builds that business confidence and that certainty is absolutely critical. We can provide some resilience in the near term through interest rates and others, but it's that turn in the investment cycle that will be so critical for turning South Africa into a 2, 3, 4% growth economy from the 1% we've been for a while. That looks delayed, frankly. I thought that was going to be the story of 2025, but global developments have rather derailed that. I think we're probably still on track in the years ahead, but that's what I would watch most closely to work out for the broader direction from the country. Let me leave my formal comments there. Dennis, hand back to you.
Thank you very much. Very informative. Jeff, maybe just a question from myself. What is the Absa House view on the, and because we're sitting in the UK, the pound ZAR exchange rate?
That's a great question. You know, I presume we'll make this pack available to everyone afterwards. The very next slide in my pack had the rand, sterling rand exchange rate, and I thought actually it doesn't quite fit in my flow. In terms of a forecast going forward for rand pound, our sense is that first and foremost we can see some rand recovery. And that might feel strange in the global environment we're in, but it speaks to technical positioning. There aren't many people right now that own, in financial markets, own a lot of rand assets. On a purchasing power basis, I encourage everyone on the call to come and visit us in South Africa. You'll be staggered at just how far a pound goes here as a visitor. And because of the support that we're seeing from commodity prices, our terms of trade, all of those things lead us to believe that, in fact, the rand could generate some strength against sterling rather than weakness. As a headline forecast, for those most keen on it, we have a forecast just richer than 24 for the end of this year, 2370 plus minus. And for the end of next year, if you want a proper crystal ball, it's in the low 24s. But the drivers of that, I say, are sort of, we just seem very cheap to everything. We aren't heavily invested, so there's not a lot of foreign money here that can get scared and exit out. And the terms of trade should be supportive to us.
You haven't mentioned unemployment in the context of growth or lack thereof. Sorry, I'm just trying to read what it says. What real GDP growth rate do we need to support the employment to support employment growth?
Listen, the higher the better. But the casual observation is sort of this, right? So we, over the last 10 years, the country's economic growth has, in real terms, has averaged about 0.75%, 0.7, 0.8. And in that period, with our unemployment rate lens on, or just employment, how many jobs exist, we know that the economy has just really, really struggled to generate jobs at that kind of level of growth rate. So in a practical way, we know something like 0.75% just isn't enough. And that makes sense, right? Productivity should be positive. You should be better at your job this year than last year. And so your boss, whether you like it or not, should expect you to do more this year than last year with the same you, right? So back of the envelope on our side from an economics team, we think kind of 1.5 is where you start stabilizing. You'll see in aggregate some jobs created. 2% plus is where you really start to see clear evidence of that. We would be very excited for that as a bank, right? Our best, the most exciting way we get a client is not so much stealing it from one of our competitors, though I have no doubt, Cheryl, that that's very satisfying. But our best way forward are brand new businesses. It's brand people with their very first job. Think each person on this call, think about when you were a young adult, your first job, the first bank you're with, chances are better than not, you're still with that bank, right? And so economic growth of 1.5 or 2 can really start moving the needle in a positive way. Of course, if we could get a reform process such that you generate the 4%, 3, 4, 4.5% economic growth that South Africa generated in the early 2000s, we were generating 500,000 jobs a year then. That would make this place feel so very, very different. I look forward to seeing it. I don't think that's a 2025 story, but I do think government is doing a lot right now to redirect the way that the economy runs in South Africa. And I think we're in a better position to put this into our medium-term forecast now than at any time in the last 15 years.
Great, thanks, Jeff. Unfortunately, we are running out of time, but before we do, I'd just like to say thank you to you and thank you to Absa. And I'd like to hand over to Cheryl Buss, who's the Chief Executive of Absa International, just to say a few words. Cheryl, over to you.
Thanks, Dennis. Thank you for arranging the call. And Jeff, without sounding biased, I found that hugely valuable. So hopefully all the participants on the call did. So thank you very much. Just as a reminder that whilst Jeff has provided great insights into South Africa and the South African environment and the economy, of course, we're a Pan-African bank. And so should anyone want any insights into any of the other countries across Africa in which we have a deep presence, please feel free to reach out to us, and we'll obviously be happy to either come and see you on a one-on-one basis or of course, provide any of the information that you may need. So thank you for the opportunity to invite Jeff. I think that past experiences has shown us that Jeff always offers great insights in a really meaningful way. So thank you for the opportunity, Dennis, and over to you. Thanks, Jeff.
Thanks, Cheryl. And thank you for everybody that attended. Thank you, everybody, and have a good afternoon.
Thank you all.